gentlemen, good day and welcome to Ujjivan Small Finance Bank Q2 FY25 earnings conference call hosted by IIFL Securities Limited. As a reminder, all participants' lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rikin Shah from IIFL Securities Limited. Thank you, and over to you, sir.
Thank you, Neha. Good evening and a very warm welcome to Ujjivan Small Finance Bank 2Q FY25 results call. To discuss the business strategy and outlook post the results, we have the entire management team of Ujjivan Small Finance Bank. The management team is represented by Mr. Sanjeev Nautiyal, MD and CEO, Ms. Carol Furtado, Executive Director, Mr. Martin P.S., Chief Operating Officer, Mr. Ashish Goel, Chief Credit Officer, Mr. Vibhas Chandra, Head Microbanking, and Mr. Barun Agarwal, Deputy CFO. With that, over to you, Mr. Nautiyal, for your opening remarks.
Thank you so much. Good evening and welcome to our Q2 FY25 earnings call. Total disbursements during the quarter were at rupees 5,376 crores, slightly better than Q1 FY25, up 2% QOQ, but lower with respect to Q2 FY24, that is down 6% YOY. This resulted into loan book growth of 14% YOY and marginal 1% QOQ at rupees 30,344 crore as of September 24. Q2 FY25 has been a relatively slow quarter compared to previous ones. This was an outcome of expected reduction in business volumes due to implementation of MFIN guardrails and our heightened caution around the microfinance segment. While growth might be visibly slow on the overall book, performance remained robust in the secured portfolio. Affordable housing business, our second largest asset vertical, disbursed rupees 758 crore during the quarter, higher by 40% YOY and 70% QOQ. This made the affordable housing and micro mortgages book grow to rupees 5,784 crore as of September 24, adding a book of rupees 585 crore versus June 24 and registering a book growth of 43% YOY. Systematic group marketing activities across regions, penetrating deeper in select markets with better per capita income, stronger ground team, better connect with customers, and diligent customer retention plan have added to improved business. Micro mortgages portfolio, a part of housing portfolio, continues to grow stronger with each quarter. This is approximately rupees 400 crore book now as we speak, from rupees 76 crores in September 23. Customer, branch and staff referrals added an edge to the business growth. Around 60% plus of the overall disbursements in micro mortgages happened via referrals. MSME business has now stabilized with all its products, policies and systems in place. Disbursements have picked up and will continue to see an uptrend QOQ. During Q2 FY25, MSME vertical disbursed 216 crore versus 130 crore in Q1 FY25. This resulted in achievement of a book of rupees 1,514 crore, up 5% YOY, 7% QOQ, adding rupees 100 crore of incremental book in H1 FY25. To further strengthen the product suite, we have introduced Elite LAP product in addition to the base LAP offering, and this is helping in increased business volumes. In Q2, we also launched bank guarantees and the working capital term loan variant, making our working capital offerings comprehensive and full stack. Apart from growing the book, our focus is also in managing asset quality of this portfolio. Our revised MSME strategy has resulted in a better quality, growth, mix, and health of the portfolio. Our FIG book as on September 24 was rupees 2,042 crore, contributing 7% to the total asset book. This book grew by 57% YOY and 13% QOQ and continues to scale as per the strategy of increasing the secured book of the bank. Vehicle finance streamlined its business process and strengthened infrastructure in the last quarter. and made full use of the upgraded capabilities during Q2 FY25, disbursing rupees 82 crores, leading to a book of rupees 262 crore, up 105% YOY and 20% QOQ. The team is poised well to drive higher business in the upcoming festive months by capitalizing on upgraded technological enablements, dealer tie-ups, partnerships, offering competitive rates, and better utilizing cross-sell avenues. Similarly, gold loan business has expanded well, currently being offered from 162 branches across the country and targeting to cover over 200 branches by end of next quarter. Disbursements have been rising incrementally month on month, and over 40% of the monthly business is coming from referrals. This has led to a book of 62 crore, growing over 100% QOQ. Going ahead, special focus will be on process enhancements and introducing products and features to better serve our customers. Our secured portfolio as at September 24 is 34.9% of the total book. The strong growth in the secured book has led to a faster progression towards 60-40 unsecured-secured book mix. We anticipate that secured book will reach around 40% by end of this financial year. Bank has always followed a risk-calibrated approach. In order to de-risk the portfolio, we had diversified our product suite and continue to make steady progress by offering relevant products to our customer segment. In the last 18 months, we have introduced products like micro-mortgages, gold loans, two-wheeler loans, agri and working capital SME loans. And it's good to see that these 5 products alone now contribute 6% of the quarterly disbursements in Q2 FY25 versus 4% in Q1 FY25, with this portfolio growing 29% QOQ and 3x YOY. Let me now come to microfinance. As mentioned in our Q1 earnings call, the microfinance segment has seen some challenges and the situation continues to evolve for the financial year 25. Basis our current understanding, we believe that business revival on a reasonable estimate will only be visible from Q4 FY25 onwards at the earliest. To steer through this, we have devised a prudent approach and restricted disbursements to new to credit NCC and stopped new customer acquisition in problematic clusters of some states. We have cautiously acquired only 1.5 lakh new group loans and individual loan customers during the quarter, who had demonstrated better credit behavior. Our approach during this quarter was serving good quality repeat customers. Additionally, we have also introduced stringent norms for new to bank customers with 3 existing MFI lenders, 1.5 lakhs MFI exposure for all new to bank sourcing. PIN code / center-wise decisioning for repeat loan and top-up loan is in place. We continue focusing on the graduation of good customers from group loans to individual loans. Around 90% of the overall individual loan book is from this migration. Due to these factors, we will continue to see a degrowth in our group loan portfolio for this year, which will weigh down our overall portfolio growth. We have enhanced our focus on building the individual loan portfolio, which continues to show much better health and prospects. We will strive to achieve the lost ground to some extent from our individual loan segment and other businesses. Coming to liability business, total deposits grew on a strong retail footing to 34,070 crores, up 17% YOY and 5% QOQ. Retail deposits at 24,746 crore now constitute 73% of the total deposits, having grown 32% over September 23. Our deposit strategy emphasizes on increasing the wallet share of existing customers along with quality acquisition of new customers through a mix of physical and digital reach. Focus on providing solution-based approach continues, and accordingly, we have created the products and features which are relevant for the segment, like introducing non-resident Maxima in Q2 FY25, a variant of Maxima account launched last year. We also introduced Navratna family program focused towards HNI customers and their families. We are targeting relationship management to ensure that at least 3 to 4 products / services are added to each customer. This has also added to improvement in ticket sizes and stickiness of the customers. CASA book at 8,832 crore now forms 25.9% of total deposit book, is up 26% YOY and 6% QOQ. Value-add products are showing healthy traction. Maxima SB book stands at rupees 1,323 crore with 21,000 plus accounts as on September 24 with average ticket size of rupees 6.17 lakhs. Our strategy is to keep enhancing our offerings. In line with this, we had applied for AD1 license, and I'm happy to share that we received the RBI approval and secured the license earlier during the month. This will enable us to offer full-fledged bouquet of products and services like engaging in retail foreign currency deposits, remittances, currency exchange. We shall also engage in foreign currency transactions, borrowings, and in trade finance offerings. This will lead to an incremental avenue of other income aiding our P&L and also widening of our MSME product offerings. On asset quality, as mentioned earlier, we are observing stress in the microfinance segment, due to which our PAR has increased to 5.1% in September 24 versus 4.2% in June 24. PAR 0 for our group loan portfolio has increased to 5.5% in September 24 versus 4.1% in June 24. In Q2 FY25, we have seen credit cost of rupees 151 crore versus 110 crore in Q1 FY25. Due to this, we anticipate full year credit cost may now be around 2.3% to 2.5%. We are strongly monitoring our portfolio quality. GNPA/NNPA as on September 24 stands at 2.5%/0.6%. Slippages for Q2 FY25 were at rupees 243 crore versus 192 crore in Q1 FY25. During Q2, slippages in microfinance book are at 0.99%, while in secured book, the slippages remain steady at 0.44% for the quarter, same as in Q1 FY25. We have written off rupees 140 crore during the quarter. We continue to focus on collections and have ramped up the collection team by adding over 300 personnel during the quarter, taking the count to 2,200 plus. Bad debt recovery continues. Rupees 25 crore was recovered in Q2 FY25. Our target is to collect over rupees 100 crore this year. On financials and margins, the NIM for the quarter is 9.2%. Yields on the overall portfolio have declined marginally due to the growing mix of secured portfolio. We are likely to see further compression as secured book will continue to grow at a faster pace. Cost of funds for Q2 FY25 at 7.5% remains at similar levels versus last quarter, owing to focused approach on growing retail deposits. Operating cost for the bank is a key monitorable. Cost to income ratio for the quarter ended at 60%. Our objective is to keep this in control in the upcoming quarters. PAT for the quarter was rupees 233 crores and subsequently ROA and ROE for Q2 FY25 is 2.2% and 15.7% respectively. Similar softness in return ratios will be visible for the full year financial year 25. However, we are very confident that once the microfinance business springs back into a growth trajectory, ROE of 18 to 20% is achievable for next year, financial year 25-26. Last but not the least, I will want to highlight my key areas of focus for the coming quarters. Microfinance is the largest portfolio for the bank. We shall continue to do well in this segment once situation normalizes. Profitably expand the non-microfinance secured portfolio. We are giving heightened focus to growing the MSME book. Green shoots are visible in our portfolio and we are confident that MSME book will do very well. B, scale up vehicle finance, gold loan and agri businesses. C, continue to expand our housing loan and micro mortgages portfolio. 3, our objective is to make the bank a retail deposit franchise with continued focus on growing CASA. Ujjivan will see stronger growth in this business ahead. 4, lastly, on the other income, we will garner avenues to enhance our other income. Special focus will be on product services. Just as we added AD1 license, we also will be adding mutual fund distribution and ASBA facility during this financial year in addition to other insurance product offerings. I end here and hand over to the moderator, Mr. Shah. Thank you. Over to you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Before we begin, a gentle reminder, in order to ensure that the management is able to address the questions from all the participants, please limit your questions to 2 per participant. I repeat, please limit your questions to 2 per participant. Thank you. The first question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi, good evening. Sir, your credit cost guidance of 2.3 to 2.5% implies maybe further worsening of trends in Q3 and then even provisioning, elevated provisioning continuing in Q4. So, have we seen absolutely no improvement in October in terms of collection efficiencies in the ND account? And if you can also give more color on the microfinance portfolio in terms of, what percentage of portfolio would be borrowers having, 4+ loans and indebtedness of more than 2 lakh? And then what percentage of this pool is already an SMA and NPA?
Sure. So, in Q2, our non-delinquent portfolio, which is the regular portfolio, saw a collection efficiency of 99.23. And in October, the first few days, there were holidays, but we are seeing a much better NDA collection efficiency in the month of October compared to the month of September. Of course, there are about 7 days for the month to end, but the initial trends of the first 3 weeks are much better than the month of September. So we are seeing, improving collection efficiency, and we hope that in this quarter, our collection efficiency in the non-delinquent portfolio will reach back the Q1 levels. Your second question was on? Sorry.
Yeah, I'll just repeat.
The five lenders? Yes. So we have about 7% of our borrowers in 4+ lenders, and the slippages on that was higher than the borrowers with 1, 2, or 3 lenders. The overall slippages from there is about 4 or 5% higher than the regular ones. I'll just give you the right numbers on that.
And the second question is on, has there been any change in the write-off policy which led to higher write-offs? And what is the reason behind reduction in Tier 1 capital in this quarter?
There has been no change in the write-off policy. However, we have written off about 50 crores of our Assam portfolio, which was NPA since 2019. That is about 50 odd crores, and that has, we were carrying that as a NPA portfolio not written off. That is one additional write-off that we have done during this quarter.
We have paid dividend during the quarter of 290 crores. That has resulted into a dip into CRAR ratio, capital ratio.
Sorry, sir, it was not very clear. Can you just repeat again on the Tier 1 capital reduction?
Yeah, we have paid dividend during the quarter. That has resulted into a dip in the capital ratio.
290 crores.
290 crores.
Oh, that was a large number. Okay. Thank you. I'll come back in the queue.
So the question on slippages, about 10% of our slippages comes from 4+ lenders. So the contribution is 7% and the slippages are about 10%.
Got it.
Thank you. The next question is from the line of Renish from ICICI Securities Limited. Please go ahead.
Yeah, hi sir. Just 2 questions from my side. Let's say on the individual loan side, we have been growing this book quite aggressively since past many quarters. And as you rightly said, 90% of these customers are actually migrated customer from the JLG book. So what are the current trends in that book? And do you foresee asset quality sort of worsening in that book also in second half?
So, when we were taking, precautionary measures during the first and second quarters of this financial year, we also slowed down the growth of our individual loan portfolio. The group loan to individual loan migration is about 90%, as rightly mentioned. So the slippages and the NPA of individual loan is much better than the group loan portfolio. So the impact has been largely on the group loan portfolio. If we look at the September numbers, IL GNPA is below 2%, and that gives us a lot of comfort that the IL portfolio can be grown much more profitably, and therefore we continue to focus on that portfolio.
Okay. And would it be possible to share similar data point for IGL book customer as well, like customers with more than 3-4 lenders?
In IL, these customers have mostly relationships with Ujjivan. However, we can come back to you whether our customers also have loans outside, if that is what you're referring to.
Yeah. Okay.
Sure, we can come back to you on.
Sure. And so secondly, on this credit cost guidance, right? I mean, so we have been saying that for the full year, credit cost will remain 2.3 to 2.5. And when we look at first half trend, it is broadly 1.7, 1.8 types. So it naturally means that second half will be, more elevated, maybe around 2.7 or 2.8 type. And when we look at the collection numbers, or even in your opening remarks, you are highlighting that our collections are better. So actually, I'm not able to connect the dots. At one end, we are saying things are improving, and on the other hand, we are increasing the credit cost guidance.
So, credit cost typically comes with a 90 to 180 day lag from the date when a customer has gone into delinquency. So what we were referring to is an improved collection in the non-delinquent portfolio. However, we have seen 99.23% of non-delinquent collection efficiency in Q2. When these customers get into 60, 90, 180 DPD, that is where the credit cost will start to pick up for this set of customers. So for Q2, whatever has moved into delinquency, the credit cost would be a outcome of that number.
No, sir, then it is, then this collection efficiency has no meaning, right? Because it's X-bucket collection. So why can't we start giving X-arrear collection as well?
X-arrear collection is 99%. X-arrear collection is 106%. X plus arrears.
No, I'm saying collection excluding arrears. I think what...
that is 97. Okay. You're talking about non-delinquent plus the delinquency, the delinquent pool. That is 97%.
But that includes overdue collection as well, right?
That includes overdue collections. That is right.
Yeah. So I'm saying excluding overdue collection.
The way we measure our collection efficiency, and this is what we have been putting up on our deck as well, is we have non-delinquent portfolio collection efficiency, which we mentioned is 99.23, and overall collection, which is due versus collection, at 97%. The additional collection, which could be prepayments or others, that's a separate number. Including that, the number goes up to 106.
Okay. Thank you. That's all.
Thank you. The next question is from the line of Ashilesh Sonje from Kotak Securities Limited. Please go ahead.
Hi, team. Good evening. Firstly, on the MFI book, just wanted to get a sense, what proportion of the overall MFI portfolio of 193 billion which you have, what proportion would be outside the scope of the MFIN guardrails?
So we have about 7% of borrowers who have 4+ relationships. So this translates to 93%, which have 3 and below.
But would you need to abide by those guardrails for the full 100% of your portfolio? Because some of these borrowers might have incomes, let's say, about 3 lakh rupees. So technically, they won't qualify as microfinance from a technical definition perspective, right? And you might not have to abide by the MFIN guardrails for that set of customers.
We have customers with the family level income is more than 30,000, and yes, you are right. Technically, we don't need to abide by the MFIN guardrails, but we decided that we'll go ahead with that. Earlier also we were using it, and after the implementation of guardrail, and our own guardrail is actually stricter than MFIN guardrail, which is implemented for both customers having less than 25,000 income and more than 25,000 income as well.
Understood, sir. Perfect. And secondly, you mentioned the slippage number for the quarter at roughly, I think, 190 crores if I back calculate based on the number you have given. Firstly, is that correct? And also, can you give a corresponding number for the previous quarter, the MFI slippage number?
So it was 193 for the previous quarter and 240 for this quarter.
Okay, understood. Then just one clarification. You mentioned a number of 7% borrowers who are 4+. So that is 5 or above, right? 5 or more lenders, right?
4 and above.
That includes 4 as well?
Yes.
Yes, it includes 4.
Okay, but the MFIN guardrail still allows 4 lenders, right?
Yes.
Would you have a number for borrowers? Yeah.
Yes, 7%, around 7% number that we are saying, it is 4 and above. This includes 4 also.
Okay. Would you have a proportion of borrowers who are associated with 5 or more lenders? Because that actually would be the ineligible set of borrowers, right?
We are a little aggressive on that, and that's the reason why we count 4 and above.
So we don't have 5 and above as of now. We've been only working with 4 and above because that is something that is the reason for us to worry. 5 and above is anyway out of the consideration set.
Understood. Perfect. Thanks a lot, sir.
Thank you. The next question is from the line of Shailesh Kalani from Centrum Broking Limited. Please go ahead.
Thanks for the opportunity. So just one question on the miscellaneous income side. There seems to be a Q1Q sharp jump, and so wanted to understand and get some color. What kind of this is what is the reason for this jump up? And because in the comments say in the PPT, foreclosure, late payment, and other charges. So how sustainable it is? Just wanted to understand that.
Yeah, we have introduced new MAB charges for customers in Q1. That has resulted into the spike by 12 crores in the miscellaneous income. There's a quarter-on-quarter, the spike is 12 crore rupees.
Sir, I didn't understand. Which charges you said?
MAB, minimum account balance charges.
MAB, okay.
This is a
Non-maintenance of MAB charges.
Okay. So that has resulted. So it is quite sustainable. That is what you're saying?
Yes, we will continue charging customers who do not maintain their minimum balance in the account.
Obviously, because this maintenance charges were not there, and we introduced sometime in last year, and we gave some time, and after that we introduced it, and the charges came in. But with time, obviously, it will little go down because customers start maintaining balance. So numbers will slowly decline, but it will still be there in every quarter.
Okay. So second question would be on micro mortgages. We have a decent exposure over there, and that book is also ramping up. Do we so any overlap between two products, MFI and micro mortgages, what we have in our portfolio? And any issues in terms of asset quality over there?
We've built a book of 300 crores over the last 18 months. About 50% of this book comes from individual loan customers who graduate to micro mortgages. In this book, we have not allowed new to credit. In fact, new to credit is only 1%. Everybody else has a history, a bureau history, and the bureau, cutoffs are quite high. As of today, we see a, on-time repayment of 99.5% and a full month repayment of almost 100%. In fact, only 9 or 10 customers out of 8,000 customers are in delinquency. So we maintaining this a very tight monitoring on this portfolio.
Okay. So just last question from my side. So can you just reiterate the revised guidance if we can? Because last time we have the guidance of growth of around 20%, similar growth for deposits, and we have already revised the credit growth guidance. How about ROE? If you can just share those three numbers.
So actually, on the business side, we are saying that, our secured portfolio will grow by 40+%. Our individual loan in the microfinance book will grow by 17% for the full year. We are not penciling on the microfinance group loan growth or degrowth because we feel that it is still, a little ambiguous. Clarity is still not there. So we refrain from, giving you a guidance on that. And therefore, the return on equity is going to soften, as you would have seen in the results that we've shown for the half year. And again, this will be subject to how bounce back we see in the group loan business. That will actually decide where we actually, zero in. So on the business side, this is what we say. Credit cost, we've already said 2.3 to 2.5%. Secured book would be around 40 to 40%. Hope that answers your query.
Yes, sir. Thanks a lot, and best of luck.
Thank you. The next question is from the line of Saumil Shah from Paras Investments. Please go ahead.
Hi, thanks for the opportunity. Is there any update on the universal banking license?
This matter is under active consideration, and we would, once we do that, we would announce it and let you know about it.
Okay, so can we expect it in this quarter?
It's work in progress. This financial year seems likely.
Okay. And so we do have a floating provisions of 250 crores. So why we are not utilizing it to reduce our NPA?
The floating provision can be utilized only in extraordinary circumstances with prior approval of RBI. And therefore, when we took the floating provision, we have taken it for an event which is unforeseen. Like something like a pandemic or something which disturbs the portfolio quality. We don't use it on a normal basis. Currently, we have utilized it only for PCR computation and NNPA computation. So therefore, and we still have 100 crores of unutilized, floating provision. We'll keep it at this, at this level, and as and when required, we'll use it.
Okay. And the last question from my side. So in the first half, our loan book has grown by mere 2%. So now, what can we expect to close this loan book by the end of this year?
I think I just now, highlighted how the book is going to pan out. Secured book overall, which is, gold loan, vehicle loan, housing loan, micro mortgages, MSME and agriculture, that will grow by 40 plus percentages, more than 40% for the full year. Individual loan in the microfinance book will grow by 17% for the full year. We are not, announcing anything on the group loan side in the microfinance book because we find that the situation is still very fluid and evolving. And therefore, that number we refrain from zeroing in, and the other parts is as I just now suggested to you.
Okay, that's it from my side.
Thank you. A gentle reminder. In order to ensure that the management is able to address the questions from all the participants, please limit your questions to 2 per participant. I repeat, please limit your questions to 2 per participant. Thank you. The next question is from the line of Jai Prakash from L&T India. Please go ahead.
Hi, sir. I have 2 questions. Like you said that you have stopped business in most of the clusters where the business is impacted, and which strategy you following there for collection?
So we have, some branches which we call, stressed branches. And in those branches, we have put restrictions on growth. And these restrictions on growth are, not acquiring new customers, not acquiring, new to bank, new to credit customers. As and when we find that customers are showing some signs of delinquency, not giving them repeat loans, no top-ups, etc. So these are the kind of restrictions we have put for branches, which are showing higher signs of stress.
If I heard you right, we have not stopped business anywhere. Repeat customers, we have over 40 lakh borrowers, and at this point of time, in turbulent time also, over 80 bank customers are paying on time, on date, and we have a good eligibility in repeat loan. So we are serving our existing customers through repeat loan and graduating them to IL.
Which states the major portfolio you have